Principle of polarity is the idea that former support turns into resistance, and former resistance turns into support. It's an incredibly simple supply and demand concept that many seem to miss, but once the psychology driving polarity is understood, it becomes clear why it's one of the most important principles in technical analysis. These critical price levels constantly switch their roles from support to resistance, and from resistance to support. A former top, once it has been surpassed, becomes a bottom zone in a subsequent downtrend, and an old bottom, once it has been penetrated, becomes a top zone in a later advancing phase. This is the most widely applicable principle in the field of technical analysis. Many traders even make their living out of trading by relying solely on this principle and nothing else. According to this principle, whenever support is broken, its role is reversed, and it begins to act as new resistance. Similarly, when any resistance is broken, it changes its role, and tends to act as the new support level for the price. In other words, the former support becomes the new resistance. The chart illustrates how a resistance, once broken, changes into support. This happens due to a shift in the levels of supply and demand. Whenever a resistance level is breached, it is generally because something fundamental has changed in the market, and the buyers are now willing to pay even higher price than before, and sellers also want to sell at higher prices. This causes the price to rise above the resistance level, and pushes it into new territory. But when the rally cools off, and prices approach the former resistance, now support, the market participants remember it as an important level. Ideally, if the change was for real, then the price should not break below this level into the older territory.